In 2008, we financed houses we couldn't afford. In 2025, we're financing burritos. Sounds dramatic? Maybe it should. Recently, Klarna, the buy now, pay later app, made headlines because people started using it to pay for takeout. We're talking $12 burritos on installment plans. At first, it's funny.
Do applicants ever get rejected?
Seriously? Look, if they get rejected, I suck at my job.
But then you stop and think, what happens when thousands of people can't pay back their Klarna debts? Is this the start of another financial bubble? Let's break down what Klarna actually is, how it works, why everyone's using it, and whether it could become the next big short. Klarna is what's called a buy now, pay later service, or BNPL if you want to sound like you work in fintech. Here is what it actually means. You're shopping online. Instead of paying $60 for those new sneakers upfront, Klarna gives you an option. Split the payment into smaller chunks, say $20 today, $20 in 2 weeks, and another $20 2 weeks after that. You get the sneakers right away, Klarna pays the store upfront, and then you owe Klarna. There is usually no interest and no fees. But if you miss a payment, you could get late fees, debt collectors, and even a credit score hit depending on where you live. Klarna is not alone, by the way. There's also Affirm, Afterpay, Zip, but Klarna is big in Europe and now growing fast in the US. Millions of users, billions in transactions. And Klarna just teamed up with food delivery apps like DoorDash and Grubhub, which means people are literally financing their lunches and dinners. As in, split this burrito into 4 easy payments of $3. At first, it's hilarious. But then you realize if someone needs a BNPL loan for a $12 burrito, they're probably not in a good place financially. And Klarna is betting on that person paying them back. But what if they don't? So here's the bigger problem. Klarna and the whole BNPL industry is built on one very big assumption, that people will pay them back. Sounds familiar? But right now, that's starting to look shaky. A 2023 report showed that around 40% of BNPL users in the US were already falling behind on payments. And those are small payments. $20 here, $50 there, but it adds up. And Klarna isn't alone. Other BNPL firms are seeing rising default rates too, which makes sense when you realize that a lot of people are using these services not for luxury shopping, but for essentials. Groceries, bills, even rent. It's like a credit card without the long credit history or heavy regulation. And another thing, Klarna was once valued at $45 billion. That dropped to $6.7 billion in 2022. Why? Because investors started questioning whether this model actually works long term. And if the whole system is built on people constantly buying and constantly paying, what happens when people stop paying? So how does Klarna actually make money? Spoiler, it's not from charging you interest. Klarna's main revenue comes from retailers, the businesses you shop from. Every time you use Klarna to buy something, the retailer pays Klarna a cut, usually around 4 to 6% of purchase price. Why would a business agree to do that? Simple. Klarna helps people spend more. If you only have $20 today, Klarna lets you spend $80. And more spending means more sales. So Klarna's model is based on 2 things. You spending a lot and you paying them back on time. But when the economy slows and when people start defaulting, Klarna still has to pay retailers upfront, but they're not guaranteed to get it back from the customer. Add that to rising interest rates and tighter regulations, and you've got a business model that looks solid in boom times, but fragile when things go sideways. Oh, and Klarna was until recently planning to go public. They were eyeing a $15 billion IPO, which is initial public offering, on the New York Stock Exchange. But thanks to market chaos, shout out to new tariffs, they've decided to postpone it. So yeah, BNPL feels easy. No interest, no fees. What's the harm? But it can be a debt trap in disguise. Because unlike traditional credit cards, BNPL doesn't always feel like real debt. It's so frictionless. One-click checkout, instant approval. You don't really think about it. Until suddenly, boom, you're juggling 6 Klarna payments, a gym membership, Spotify, and you're wondering where your money's going. So, is Klarna the next big short? Not exactly. There's no Wall Street level collapse happening tomorrow, but there are warning signs. You've got millions of users borrowing small amounts they may not be able to repay. You've got investors pouring billions into companies that are, in some cases, losing money. You've got a whole industry built on the idea that people will always keep spending, even when they can't afford to. 2008 started with people defaulting on small loans. Then things snowballed. Could buy now, pay later be a smaller, modern version of that? Maybe not as dramatic, but still a sign of an overstretched economy? I guess time will tell. But for now, just maybe pay for your burritos upfront. If you found this interesting or mildly terrifying, feel free to like or sub. Thanks for watching and see you next time.